Well, in the wake of the banking crisis, credit conditions are tightening. Yet, despite substantial liquidity, banks in the US were already tightening lending standards, points out Paul Ashworth, who is the Chief Investment Officer at Cameron Harrison, and he joins us now. Paul, very good to catch up with you again. So, interested to get your view what's going on with the banking crisis. Perhaps, we're seeing that global fears have dissipated somewhat, yet still caution, obviously, that more could be at stake here. I guess particularly given some concerns that have emerged over Deutsche Bank.
Yeah, I think the key point for us, Andrew, is yes, we have financial conditions, as you pointed out, were already tightening significantly. If we look at the US federal senior bank lenders survey, they're getting to recession-like tightening levels, and that was before the recent turmoil in terms of the banking sector. That will resolve itself. Central banks, they are throwing the kitchen sink. The Federal Reserve, just off the top of my head, it's running 10 different liquidity programs at the moment. We've long said that it's all great having post GFC all these additional capital requirements, but for capital to be adequate for banks, banks would need 40% capital for it really to make a difference. The name of the game is liquidity, and the Federal Reserve is certainly throwing all of its various liquidity windows at it. But for us, there you go. There's the we can see that in terms of that black line there, which is actually inverted. So as you see it on the right-hand side there, that's getting to pretty significant levels. It's approaching the COVID crisis levels, the GFC levels, tech crisis levels, early 1990s recessions levels. So I suppose the point we're saying is, from a real economy perspective, this is unfolding real time. The Federal Reserve, as we think also will be the case with the Reserve Bank here, almost on a blind path to inflation destruction, but with inflation destruction also comes real economy destruction. So flowing that into equities, Andrew, our base case is that we've got an outlook for significant contraction in economic activity in the second half of this year. And that has implications, for how we see US equity markets at the end of this year going into 2024. We are big believers that the order of growth rotating into value, kind of the end of secular stagnation, higher nominal growth rates, higher interest rates. We think that thesis is still strongly remains in place, but recession's not good for those cyclical companies. So whilst we think those type of businesses will do well over the medium term, there's certainly a bit of pain ahead for those cyclical industrial businesses in the US, and also we can see that in other Western economies, but particularly in terms of the US. So before that 2 to 3 year rotation into value really gets steam, we've got a little bit of pain ahead as the Federal Reserve drives this economy not into a soft landing but in a reasonably hard landing.
So, Paul, as you point out there, those tighter lending conditions obviously going to impact business investment. We're also seeing what's going on just as far as consumer behaviour. The housing sector's been affected, which all leads, as you point out there, to slower economic growth. Is there a risk that stagflation could still perhaps emerge, given what's going on with inflation at the moment and still hasn't come down to those levels, obviously, that the central banks want?
Well, yes, like I think there is that risk. I think the Western industrial countries and their economies and businesses within that can actually draw out good earnings growth and moderate cost. Government spending. There's not a day goes by either here or in the US where a request for government to be involved and intervene and support occurs and largely gets funded. Government is obviously a key part of it, and it's a key part of when we say value, we're really saying cyclicals here, Andrew. It's business that is tuned into the fact that government is a key component in growth going forward. Together with energy transition and the significant flows in terms of that. So yes, there is that risk, but it's one that we would think is more moderate at this point in time.
So, and Paul, you've also got your eye on those credit spreads. What you're arguing they should, in fact, be wider given what's playing out at the moment?
Yeah, all things being equal, we think US credit spreads for volatility should be higher. And that's kind of what we're in the same in terms of US equity markets responses. We think risk markets have been a bit too benign. Given recent events, we think equity markets have been a bit too benign, and so that again that lays additional forward risk that can perhaps cause problems for bond markets going forward and equity markets.
Regionally, which markets are you preferring at the moment?
When we for example, when we look at something like value to growth, there are obviously economies like Australia where there's good weighting to that and there's some preference. But we also see in terms of the US market, which is obviously has got a fair domination in terms of growth within its index composition. But there's some fabulous businesses there that will do equally well on a sectorial basis. So our preference would be, Andrew, to look at it more on that sectorial basis rather than be wholly focused on a regional basis. That'll be the best way to to play that cyclical compared to growth equity story over the course of the next 12 to 24 months.